As weird as a Jade Lizard option strategy might sound, this is a really good income source for people that have a small to about a mid-size account with around $3,000 and have a little bit of trouble picking which way that a stock is going to go. So if that sounds like you, then stay tuned. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about the Jade Lizard option strategy. I've gotten a few comments requesting this video, so here you go. To break this video down for you, first I'm going to talk about the basics behind the strategy, talking about strike prices, expiration dates, break-evens, the whole 9 yards. After that, I'm going to take you through an actual example with a real stock, and finally at the end of this video, as always, we're going to talk about the risks that are associated with the Jade Lizard option strategy. But before we get into all that, if you enjoyed this video or if you learned anything out of it, make sure to show some love, leave a like, and let's get into it. The Jade Lizard option strategy is very similar to an Iron Condor. And if you don't know what that strategy is, basically it's a non-directional trade where you think the stock is going to trade between two different strike prices. So you're betting on the stock trading flat for the most part. And whenever you open an Iron Condor, you're going to use a call credit spread and a put credit spread. And you want the stock to be between those credit spread strike prices. But with the Jade Lizard, instead of opening a put credit spread on the downside, we're going to use a naked put. And a naked put is a put option that you're selling and you're covering the collateral that you would need in order to buy 100 shares of a stock with either margin or a mixture of margin and cash. So obviously, you're going to need a margin account in order to trade this, and you're also going to need level 4 options trading enabled in order to use the Jade Lizard option strategy. And once you have this, the way that you're going to set your strike prices is by finding a call spread that's going to pay you 30% of the difference between your strike prices. So if I have a $1 spread or $1 difference between the strike prices for my call spread, I want to get at least $30 of credit in order to open that call credit spread. So we're betting on the stock being below those strike prices, and now we have to open a naked put option. And the naked put that we sell needs to make up for the difference between our strike prices minus the credit that we got. So this means that we need to receive at least 70% of the call spread as credit for our new naked put option. And the reason behind this is so we don't take a loss on the upside. If the stock ends up going above our strike prices on our expiration date and we take our quote-unquote maximum loss, it's going to be equal to 0. And the reason for this is because we're just going to be buying and selling our options for their intrinsic value. So if we have a $1 difference in our spread, but we got $30 of credit and then $70 of credit for the naked put, we'd be getting $100 of credit total, and we'd be buying and selling the shares for a $100 loss. So all in all, this comes out to 0. You're not going to lose anything on the upside for the Jade Lizard option strategy, and that's the benefit versus the Iron Condor. But there is going to be risk towards the downside, and this can get pretty significant. Stick around to the end of this video where we talk about the risk. But for now, let's talk about expiration dates. The rule of thumb whenever you're selling options or whenever you're using credit spreads is 30 to 45 days until your expiration. And this is just the sweet spot where options lose their most amount of extrinsic value. In that last 30 to 45 days, that's when time decay really starts to ramp up and takes away most of the value for these options. And time decay is going to get more rapid as time goes by, so you can use weeklies too. And in the last week, options are going to lose way more premium than in the last 30 to 45 days. So you can use either weekly options or you can use monthly options or the third Friday of each month. I prefer the monthlies, but that is just my preference. So that's strike prices, expiration dates for you. Now let's talk about break-even prices. Now, there's only going to be one break-even price since we can't lose anything if the stock ends up going above our call strike prices. But on the downside, our break-even price is going to be the put that we sold, the strike price for it, minus the total amount of credit that we got. So, for example, if I sold a $45 put and then had a $55, $56 call credit spread, and I got $100 of credit in order to open this trade, my break-even price towards the downside would be the $45 strike price minus $100 of credit divided by 100 since we're controlling 100 shares. So our break-even price would be $44, and anything below that, we're going to end up taking a loss for buying the 100 shares. Anything above that, we would be at a small profit. And if our stock is between our strike prices, 45 and 55 on our expiration date, that's ideal. That's when we realize our maximum profit, which is going to be the total amount of credit that we got for opening the spread. So in this case, $100. And then the maximum loss, whenever it comes to the strategy, is going to be infinite. And that's because we're selling a naked put option, and naked options always have an infinite risk profile. Now, there's ways that you can guard against this, and I'll talk about this in another video. But for now, let's get into our actual example. Whenever you use the Jade Lizard option strategy, ideally you want to choose a stock that you're actually okay buying 100 shares of, because if you get assigned on your naked put option, you're going to have to buy 100 shares of your stock at your strike price. And it can be pretty tricky to find a stock in the $30 to $50 range if you're starting out with just $3,000. But I think that a decent candidate for this right now might be Snapchat. So I'm going to go to their option chain. I'm going to set my expiration date to the next monthly option, which is going to be on March 18th. I'm going to go to the call option chain and then scroll up to find a call credit spread that would pay us about $30 a credit, since the difference between our strike prices here is just $1. So for Snapchat, I'm going to sell the $43 call and then buy a $44 call and a call credit spread that's going to pay me $29 a credit in order to open this side of the trade. And then the next step in the strategy would be to go to the put chain and then scroll down the option chain to find an option that'll pay us at least $70 of credit. So if we sold this $32 put option right here, this is going to pay us $80 a credit, which means that we get $109 a credit in total for opening this trade. This means if Snapchat is trading between our $32 put strike price and then our $43 call strike price that we sold, we get to keep that full $109 of credit. If Snapchat goes above our $44 call strike price that we bought, then we're actually still going to be at a profit. So that's the benefit of using this strategy versus the Iron Condor. If Snapchat was above $44 on our expiration date, we would still come away with $9 of profit, since we're getting $109 of credit and the difference between our strike prices is $1, meaning that we would have to buy 100 shares of Snapchat at $44, sell 100 shares of Snapchat at $43, taking a $100 loss, but we got the $109 of credit in order to make up for that, meaning that we come away with $9 of profit at the end. And then finally, if Snapchat is below our $32 strike price, the put option, then we have to buy 100 shares of Snapchat at $32, spending $3,200 of margin or a mixture of margin and cash. And our break even for this trade would be our $32 strike price minus the $109 that we got in credit. So our break even would be $30.91. Anything below that, we're going to end up taking a loss. And anything above that and below our $32 strike price, we're going to be at a small profit. But you can still lose a pretty good chunk of change if you were to sell this put option and Snapchat just keeps on tanking. So let's talk about the risks. We touched on risk a little bit earlier, saying that the naked put has quote unquote infinite risk potential. Now there's ways that you can guard against this, but let's define what this actually means. Let's say, for instance, we sell a put option with a $50 strike price, and for some reason, after an earnings report or some major event, the stock ends up dropping by 20%. We agreed to buy 100 shares of a stock at $50, but now the stock is going to be trading for like $40. So if we had to buy the shares at $50 and now it's trading at $40, if we decided to sell those shares at the new $40 price, then we'd be taking a $1,000 loss. And this can really start to add up. Maybe the stock drops by 50% for whatever reason, from $50 to $25. Now, this is unlikely, but it can happen, and you'd be taking a $2,500 loss. And we only got $100 in order to open this trade, so this will be a 2,400% loss. Obviously, not ideal. And then you could also end up bag holding a stock all the way to zero, which would be your maximum loss. In that case, you would have lost $5,000. So that is how the naked put has quote unquote infinite risk potential. And that's towards the downside. There's two risks that we have to talk about whenever it comes to the upside and with our call spread. With any spread, you always run the risk of early assignment. And what early assignment is when the buyer that bought the call that you sold in your spread decides to exercise that option early. Now, the odds of this happening are pretty low, unless, of course, your option has very little extrinsic value. So this can be because there's almost no time left in the option, or this can be because the option is just so deep in the money. This is going to increase your odds dramatically of being assigned early on your call spread. But the great thing about being assigned early on the call spread is that you can exercise the option that you bought. So basically, you're doing the same thing that the buyer for the option that you sold did to you. And since you're doing this, your trade is going to end up balancing out. Whenever you exercise a call option, you're agreeing to buy 100 shares of a stock. And if you get assigned early on a call option, then you're agreeing to sell that 100 shares of a stock. So since you're buying and you're selling those 100 shares, it's the same 100 shares, this trade ends up balancing out and you don't have to worry about it. So if you get early assigned on your call spread, the easiest way that you can fix this is by exercising the option. But there are a couple things that you should note whenever you get assigned early for a call spread or any type of spread. The first thing is that you're probably going to freak out whenever you see a huge deficit of, tens of thousands of dollars, depending on what stock you're trading. If this ends up happening to you, don't be worried, because again, you can just exercise the call option that you bought against it, and this will clear your deficit. But the second issue with this is that your brokerage is going to put your account on hold to where you can't make any trades for the rest of the day. Because you have a pending transaction going on, this is going to end up locking up your account to where you can't make any trades, at least with options, I think, for the rest of the day. So if you're a day trader that needs to be in the market every single day, then obviously you don't want to be assigned early. And you can avoid this by trying to close out of your options before they become super deep in the money or long enough before the expiration date. As long as your options have a decent amount of extrinsic value in them, you shouldn't get assigned early, and you can avoid this. But the second risk associated with the call spread is the stock ending up between your strike prices on your expiration date. Now, the odds of this are incredibly low, but if it does happen, you're going to be on the line to sell 100 shares of your stock at the strike price that you sold. And since the call option that you bought is still out of the money, you can't exercise that. This means that you're going to be short on 100 shares of a stock that you don't own. So you're going to have to buy those 100 shares of a stock at whatever the market price is on the next Monday and then sell it at your strike price that you sold. And that's only if you have enough money to buy 100 shares of a stock at this price. If you don't have enough money to buy 100 shares at your share price, your brokerage is going to ask you to deposit some money. And if you don't have that, you're going to get the dreaded margin call. And nobody wants to have that, right? And there's an easy way that you can avoid this. If you think that the stock could end up between your strike prices on your expiration date, then close out of it. You can close out of it the same day at 3:59 p.m. before the market closes, and you'll be off the line to where you don't need to buy and sell 100 shares of the stock. If you think that these options are going to be clearly out of the money or clearly in the money with no chance of the stock landing between your strike prices, then you can hold this into expiration and you shouldn't run too much risk. That's all the risks that I got for you with the Jade Lizard. Hopefully you learned something from this video. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.